Ladies and gentlemen, I hope I'm wrong. I hope that I'm not right, and I hope that this doesn't happen, because this would be an absolute catastrophe for the world, and especially for the United States of America and people already suffering. There are 11 million people who face eviction, and we have a stock market now that could ruin the lives of a great many more people around the country. I think that there's going to could be a 50% drop like '08. I think that, and you know what? I hope I'm wrong, and the market can continue to keep going up. And if you look at the Dow and the Nasdaq today, they were down for the fourth consecutive day. I'm not timing anything. I'm not timing any market. I am telling you that I think, based on the numerous factors that I'm going to list and read off, reputable articles below, Business Insider, Market Watch, Bloomberg, Yahoo. I have about, 20 articles below in the description, from margin trading being at an all-time high to the fact that a hedge fund collapsed, and practically nobody in media is talking about the fact that a hedge fund already collapsed, and regulators have stated categorically that they can't protect the country. They cannot protect the country from a possible recession caused by a stock market catastrophe. Hit subscribe to this channel right now. Nobody's really talking about this on the political side. So I'll get to the politics in a second, but hit subscribe to my super chat. I can't do this without you. So to my super chat, thank you so very much. But we're heading towards, this is my prediction. I'm not right about everything, but I'm right about a lot of things. We're heading towards a market crash within the next year or so. The ride ain't over. God bless you. Hello. Thanks, everybody. Eric, thank you. Hello, everyone. To my super chat, thank you, ladies and gentlemen. I want to read you this. We're trading margin debt, another record high in March, to top $822 billion. So we are trading at we're borrowing more money than ever to buy stocks. Now, it's not just individual investors. It's obviously banks and hedge funds. They're borrowing more money. You can read this Business Insider. Margin debt, another record high in March, to top $822 billion. It's around that high right now. The market is over-leveraged, so that's one reason, okay? The number represents a 71-year-over-year jump in margin debt usage. Margin debt is used by investors to buy securities or sell a stock short, but these institutions are buying stocks with money they don't have. They're borrowing money. It's not just the individual investors. The hedge fund Archegos went under because they were borrowing money, and then they got a margin call, which means they had to pay back their money, or they lost all their positions and investments. Which the hedge funds get margin calls, which means that you have to pay back the loan because your securities or your investment has dropped a certain percentage. They get margin calls just like everybody else. So if you borrow money to buy stocks, whether you're an individual investor or a hedge fund or a bank, you're going to get a margin call, which means that you're going to have to pump more money into your investment because you've borrowed so much, and you need to pay the amount, a certain amount that you've owed. If you can't pay that amount, you lose your entire investment. You eventually lose your entire investment. But investors trading on margin like never before. This is Market Insider. Hit subscribe to this channel right now. To my super chat, thank you. I can't do this without you. Tell your friends about this channel and hit subscribe. And this is very important, so share this everywhere. Investors are trading on margin like never before, despite the risks associated with the practice. According to newly released data, margin debt rose 71% year over year to hit a record $822 billion in March. Margin debt previously spiked to record highs before dot-com bubble in 2007, just 3 months before the 2008 financial crisis. So you have to understand, the market's going to tank. I think the market is going to collapse in large part also because of this margin debt, but also inflation, job numbers missing, record miss, and there's a whole bunch of other reasons. Warren Buffett thinks there's going to be a stock market crash, so forget about me. I'm nobody. Okay? But I've been saying this also for a while. I said things are going to get worse economically, a lot worse. And it kind of dawned on me yesterday night, and I said, my God, the stock market's going to crash. You're going to have investment funds and retirement accounts collapse right when people are retiring, and they're not going to be able to find work because there are job openings, but for some reason, there's a labor shortage. And we can go into the reasons, but this economy is completely in the tank already. Once Wall Street realizes that the corporate profits are going to subside, which they're already subsiding, and once Wall Street looks at everything, like not just the fact that companies are overvalued, that's Warren Buffett's domain. Look at the overall economy. The inflation is at a 13-year high. Consumer price index is at a 12-year high. Producer price index is at a high. Look at all these economic indices. You can look. You can look at all of this, and I'll get to all of this today. And I'm going to be writing articles about this and op-eds and opinions on this. This is a huge catastrophe waiting, because when the stock market tanks, you're going to get people it's going to be impossible for banks. It's going to be impossible for banks. You can look at the economic indicators, I should say. It's going to be impossible for banks initially to give loans, or impossible, I should say, for regular people to get loans or businesses to get loans. That means people will lay off. Like, just as the economy is rebounding, you're going to get mass layoffs because of the stock market crash. Because you'll have investors, both individual and institutional, who will lose money rapidly in a very short time period, within days, within weeks. That'll set off a chain of events, just like in 2008, just like in 2000, just like in 1929, and in 87. This is not rocket science. We know what's going on. Look at inflation. Look at prices. Look at inflation. Look at the fact that, like I'm reading right now, and then there are derivatives tradings that caused Archegos, this hedge fund, to go under a couple of months back. And then the regulators said that they couldn't really do anything to stop future hedge funds. They literally said that. They literally said this. They literally just said this. So you have like I'll just read you this. Ben A. I agree you can feel it. It's 2008 squared. Exactly. Keep up the great work, HAU Rock. Thank you, Ben. Ben, thank you so very much. I can't do this without you, ladies and gentlemen. Ben, thank you. Let me tell you something, Ben. The only advice I would ever give anybody is not an investment advice, because I don't, I don't think anyone, I would never even go into that realm. I think that, Ben, you and me and everybody should save as much money as possible. Thank you, Ben. First of all, thank you for supporting this channel. Thank you so very much, as always. I hope all is well. Ben, everybody here, save as much money as possible. That doesn't mean you can't go to a restaurant, but the ride ain't over. Libra, everybody here, Eric, everybody here, if you can save as much money as possible and still live at, go to the restaurant with the significant other and with the family, just remember to save, because I don't know if it's next month, 5 months, next year, this thing's coming crashing the you-know-what down, and I don't like to talk like that. Like I said, focus on your life and happiness. Like the Filipino martial arts master said, Grand Tuan Leo T. Gage, I forgot. I don't know if I can pronounce his name correctly, but he's a brilliant, brilliant man. Leo T. Gage Jr., Grand Tuan, amazing, amazing man. And I've seen him. I've heard him speak. He throughout YouTube. He's absolutely fantastic. And he said he's a master of Pakiti Kali, the Filipino martial arts. Really, really wonderful, amazing man. And he basically has this philosophy. It's fantastic. That if, God forbid, your adversary finds you, you tell him, "I've been waiting for you." It's the best thing you've ever. It's the best thing that you've ever heard in your life. Grand Tuan Leo T. Gage Jr. Pakiti Tersha Kali, just amazing, amazing man. So, a martial arts legend. He's a Filipino martial arts legend. And he has an amazing philosophy on life. And I think that you should remember that when Leo T. Gage Jr., amazing man, you should remember that when the market collapses, because if you watch this channel, you save. The worst thing that can happen, you save your money. I think you should save as much money as possible. Forget about investing now, in my view. Just save. There's nothing wrong. You have a savings account or you have a checking account. Just save as much money as possible. Because I think there's going to be a market collapse just like '08. When you trade on margin, Ben A., thank you so very much. Thank you. So this Filipino martial arts master has the right mindset. When your adversary comes, just remember to always think, "Hey, I've been waiting for you." So if the market collapses, just say, "Hey, wait a second. I've been waiting for you," or "I've been waiting. I've been not waiting, but expecting this." So I don't know. I think that's a mindset that people should have, because this is going to really hurt people psychologically and emotionally. We have Biden today. He's focusing on everything else but economic growth. And he's completely clueless. The market's going to tank eventually, and he's going to be completely clueless. And of course, you'll get AOC and Bernie Sanders complaining forever, and they caused it. They shut down all of society for a year. They helped cause all of this. We wouldn't have a market collapse had Democrats not overreacted in a paranoid and hysterical manner. So we can get to that in a second, but here, so I'll just continue reading. According to newly released data, margin debt rose Ben A., thank you very much, rose 71% year over year to hit a record $822 billion. Look, we're borrowing $822 billion to buy stock. Margin debt previously spiked to record highs for the dot-com bubble and in 2007, just 3 months before the 2008 financial crisis. So you can look when Wall Street Journal asked James Engel, a Georgetown University finance professor, about the trend in rising margin debt back in December of 2020. The professor said the stock market is euphoric right now, and a lot of people are extrapolating from recent past. We've seen this play out before, and it doesn't end well. The whole thing's going to tank, ladies and gentlemen. It's just a matter of when. Big Baby Zubas, thank you. Thank you, Big Baby Zubas, thank you. Ben A, thank you. So you have still a number of experts have warned about the use of excessive margin debt, including Edward Yardani, the president consulting firm Yardani Research. Yardani told the Wall Street Journal that margin debt fuels bull markets and it exacerbates bear markets, and to a certain extent, you put it on a list of irrational exuberance. The further that this stock market goes, the higher the margin debt will go, and when something, causes a crash, that will be one of the factors for why stocks are going to go down. The interesting thing about this stock market, ladies and gentlemen, is when you do the research and when you read, the whole thing's going to tank, but it might not tank immediately. What will take place is there will be perhaps a correction. Maybe it'll tank one day. Maybe there'll be a little correction, and then it'll go back up. But then if it goes back up, people will realize, wait a second. People on margin now are on really thin ice. Or people on margin will have to leave the market, will have had to leave the market during the correction. So when that happens, you see a whole lot of things taking place where the fear will grow exponentially. Like, oh my God! I'm saying if there's a correction before the eventual collapse, there could be a collapse initially, and that's it, and then it has to rebound and take 5, 6, 7 months, a year, whatever. In the meantime, that would be devastating for the economy because you'd have layoffs just when people are trying to get back to work. And it would be devastating, and so many people would lose their retirement accounts. You would have a really, really big problem. But I'm saying it might not happen all at once. There could be a correction and then a slight rebound. But then during the rebound, investors will realize that, oh my God, the hedge funds like Archegos are investing in very risky derivatives trading. We'll get to that in a moment. Everyone's on margin. Inflation is at a 13-year high. Jobs numbers continue to miss expectations by like 700,000 jobs last report. Okay? And the federal regulators can't prevent another catastrophe. Jeanette, thank you so very much. Jeanette Jimenez, thank you. Jeanette Jimenez, thank you so very, very much. Jeanette Jimenez, thank you. Thank you, Jeanette. Greatly, greatly appreciate it. I can't do this without you, ladies and gentlemen. Thank you. So that's one reason. The issues pertaining to margin. Okay, these hedge funds are over leveraged. The banks are over leveraged. They're borrowing too much money. Okay, for investments that will tank, very likely. Okay, so that's a big problem. Then you have Market Watch. Here are the complex bets at the heart of the unprecedented Archegos-linked $30 billion margin call. If you're going to get a margin call if you invest, or if heaven forbid, you as an individual, just like a small investor, and you're playing the stock market, and you borrowed money, you will get a call from your brokerage firm saying, hey, you have to deposit 25, 30% into your stock now because the money you borrowed the stock is tanked, so therefore you owe us a certain amount of money to keep your position, to keep your stocks. If you can't pay, they take your stocks away. You lose all your money, okay? So you borrow on margin, you could lose all your money very quickly, all right? And so, like if you put $10,000 in the market, you borrow on margin, you can actually buy $20,000. But what happens is, if the investment tanks and the $10,000 you borrowed, they ask for, they're going to take the $10,000 in stocks that you initially just paid for without borrowing. So you're going to lose, you could very easily lose your entire investment, okay? But when times are good, you can take advantage of, you could take advantage of the debt and make money, but the problem is when times are bad, you're going to get that margin call. Well, just like an individual investor, these hedge funds will also get margin calls, except you're not getting a $30 billion margin call. They are. So they got a $30 billion margin call saying, okay, give $30 billion or you're going to lose all of your money, which they did. The people who ran this Archegos hedge fund lost $20 billion of personal wealth in 2 days. All right? 2 days. But here are the complex bets at the heart of the unprecedented Archegos-linked $30 billion margin call. Losses that trigger the liquidations of positions approaching $30 billion in value bring to light complicated financial instruments used by European investors that are effectively banned in the U.S. but could still have spillover effects. So, according to Bloomberg News, contracts for difference, or CFDs, were at the heart of some of the unprecedented trades executed by Archegos. So this type of trading, similar types of trading, is taking place right now. These similar types of derivative trading is taking place right now in hedge funds in the U.S. Okay. And regulators can't stop this type of trading. So we'll get to, I'll read you this article here. Regulators around the world monitor collapse of U.S. hedge fund. So, hold on one second. There's this other article that I want to read you. So basically, there's a certain type of trading that they can't stop. You remember credit default swaps? So these are the same types of things, and they're very risky. And what they do is you're betting on you're not buying the investment, you're betting on the volatility, up or down. There's a whole bunch of investments like that, but this is really weird, and it's what hedge funds do. And it's what caused Archegos, one of the things that hedge fund to tank. Then you find out, Christian O'Brien, thank you. I am mandating Super Chat to protect y'all from Jeanette Jimenez, thank you. Christian O'Brien, thank you so very, very much. Christian, thank you. Thank you, Ben A. Thank you. Big Baby, thank you. Jeanette Jimenez, thank you. Christian O'Brien, thank you so very much. So check it out, Christian, everyone here, Ben, Jeanette, everyone here. Check this out. This is frightening. Fed warns of hidden leverage lurking in financial systems. So the Fed has already told everybody. They're not keeping anything. Like, you hear all this stuff, end the Fed. It's like, well, you can't do that right now for a number of reasons. Christian O'Brien, thank you so very much. But they're actually pretty honest. They're actually telling you, they're actually pretty honest. They're telling you they cannot stop the market crash. So people at the Federal Reserve have already told you, they've been pretty honest, and they've told you they can't stop the market crash that's impending. So don't say it's the Fed's fault, because they're telling you they can. Well, you can say it, but they're telling you right now that this article in the Financial Times is telling you that Fed warns of hidden leverage lurking in financial system. It's not hidden. I just read that margins at an all-time high. So it's not hidden. We already know. The problem is that the smartest people in the room, this is like Enron. Our economy, the stock market is like Enron now. It's going to tank because, first of all, really quickly, Biden's administration is focusing on everything but the impending market crash or economic growth. So you could probably survive a market crash a lot easier if you focused on economic growth, like Trump would do. But you're focusing on this obsessive, paranoid, irrational, completely illogical, completely counterproductive response to a disease that doesn't end the lives of as many people as cancer or heart disease. So, heart disease and cancer end more lives every year in this country than the pandemic that Democrats have sold their soul to. Do you understand? And they're focusing on everything but, like, this will be almost 100% Biden's fault and the never Trump Republicans, but mainly Biden and his administration. This is the Afghanistan withdrawal of economics. And we still have Americans left in Afghanistan. But they're focusing on everything but economic growth. Okay? Well, you've tanked the economy deliberately, but here, Fed warns of hidden leverage lurking in financial system. Central bank says Archegos collapse shows it lacks tools to see full extent of risk-taking. It lacks the tools to see the full extent of risk-taking. So, if the U.S. Federal Reserve cannot... Ian Moyer! Zombie apocalypse circle back. Daywalkers brought us in whispers that speak volume. Ian Moyer! Ian Moyer, thank you as always. Christian O'Brien, thank you. Ben, everybody here. Jeanette. Ian, thank you so very much. I can't thank you enough, Ben. I know it's funny for me to tell my super chat this, and they're helping me support this channel, but save as much money, Ian and Christian and Ben and Jeanette and everybody here. Save as much money. I mean, go to a restaurant, enjoy your life, but every month, save as much money, because I'm not talking, don't even, this whole thing about invest in this, invest in that, now, I don't think now is the time to invest in anything. I don't care how safe you think it is or how great you think it is. I think that just save as much money. I'm telling my super chat this. Ian Moyer, thank you so very much. But every month, just like your parents told you, save every month, save. Every month, save money. Every month, if you can save $50, $100, $1,000, do so. Ian, thank you. Thank you so very much. If you can save, ladies and gentlemen, $50, $100, $1,000, $500, $1,000 every month or more, make sure you have that safety net for a rainy day, because Biden, mashed potato brains, is heading full steam towards the iceberg. Okay. And unlike the Titanic, they actually are looking at the iceberg, gleefully touching themselves in ecstasy as they head full steam ahead, faster and faster towards the iceberg. And nobody knows why. Nobody knows why. They are heading towards the iceberg, and nobody knows why, because we see it. It's right there. It's right there. And instead of veering off into another direction, instead of slowing down. This is going to be a collapse, and it's going to take 4, 5, 7, 8, a year and a half, another. The future, it needs to be bright for your life, everybody. Ian, everybody here, Christian, everybody here, Ben, Jeanette. The future has to be bright for your life. Focus on joy, love, happiness, laughter. The country is going to where in a handbasket very quickly. I don't really speak like this. It's kind of I never imagined that I would get to this point where I'm so negative. But it's not negativity, it's reality. At a certain point, there's no look. There's an article right here. U.S. Federal Reserve has warned that existing measures of hedge fund leverage, quote, may not capture important risks. Here's the Financial Times article. It's below in the description section. The U.S. Federal Reserve, people always talk about the Fed. They're telling everyone right now that we don't have the tools. We cannot. You're going to hear from AOC and Bernie about regulation. We don't have the tools to regulate right now. People are over-leveraged. The hedge funds and banks and brokerage firms are over-leveraged. They're borrowing too much money, and their investments are going to tank because they're overvalued. They're borrowing too much money to buy investments that are overvalued while inflation is at a 13-year high and jobs missed by a record number. Around 700,000 jobs that missed expectations. Or the missed expectations amounted to about 700,000 jobs difference. Are you talking about economics? The U.S. Federal Reserve has warned that existing measures of hedge fund leverage may not be capturing important risks. Thank you again, Ian, as always. I can't thank you enough, Ian Moyer. Pointing to the collapse of Archegos Capital as an example of hidden vulnerabilities in the global financial system. So the whole thing's going to tank. It's not just us. Everybody else will tank too. The U.S. Central Bank's semi-annual report on financial stability found that some asset valuations are, quote, elevated relative to historical norms, and, quote, may be vulnerable to significant declines should risk appetite fall. Don't you love how these highly educated people talk? Christian O'Brien! This is a small, powerful investment. Thank you, Christian! Thank you, Christian O'Brien. Thank you! Ring and Constitutional, bango the bells. Thank you! Thank you! Thank you so very much, Christian O'Brien and Ring and Constitutional. Ian Moyer, thank you. Thank you, everybody. Ladies and gentlemen, the U.S. Central Bank's semi-annual report on financial stability, it's right here. It's telling you. When it happens, when God forbid it happens, and I hope I'm wrong, and I hope Warren Buffett's wrong. Who am I? But I hope I'm wrong. I'm telling you, they told you already. They're telling you already. It says right here. The U.S. Central Bank's semi-annual report on financial stability found that some asset valuations, so the positions that these hedge funds hold, these banks hold, their investments are elevated relative to historical norms. Well, that might not be so bad. That just might be a bull market that needs a correction. But wait, there's more. Quote, may be vulnerable to significant declines should risk appetite fall. Christian O'Brien and everybody here, Ben, Ian Moyer, should risk appetite fall. Should risk appetite fall. What does that mean? Well, if your appetite for risk, this is how very wealthy, highly educated, very polished people speak. Oh, are you going to lose all your money? You might have to be kicked out of that mansion. Well, your risk appetite might have fallen to a point where you owe more money in margin than you have. Sorry, we'll have to repossess the Bentley and your mansion and the Gulfstream and your caviar. Your risk appetite has fallen. Now your appetite will change from caviar to grass. Not the good kind. But the Fed also acknowledged that regulators lack the tool to monitor the risk traders of people like Bill Wang, who place, so this is the Archegos, so who place large leveraged bets on stocks through Archego. The Archegos event illustrates the limited visibility into hedge fund exposures. This is the Fed governor who chairs the central bank's committee on financial stability. They're telling you, they're pretty honest. Don't say like, you know, all these people, the Fed. Like, well, they're telling you it's going to collapse. They're telling you right now, what's the problem? Why can't anybody listen? They don't watch this channel, that's why. Actually, there are a handful of people saying this, but I'm telling you, like, I am the only person in the political realm saying that this is going to collapse and it's going to be a catastrophe. And it's going to be mostly Biden, and it'll be like, it won't be Biden's fault 100%. It will be almost entirely his fault in terms of the sheer ignorance of ignoring all of this and focusing on everything but protecting us and everything but economic growth. Wealth inequality will increase. And then you'll hear more complaints from Bernie and AOC. They're the ones who help tank the economy by telling everyone to, end their economies in the most irrational response to you-know-what. But check this out. The Archegos event illustrates the limited visibility into hedge fund exposures and serves as a reminder that that available measures of hedge fund leverage may not be capturing important risks. They're telling you that Archegos, the hedge fund that went under that caused billions upon billions in losses for, Credit Suisse lost $4 billion and other banks lost billions. This hedge fund lost 30 billion. They're not even one of the biggest hedge funds. They're a smaller hedge fund. This is one of the small funds. Okay? This is one of the small hedge funds. This is not one of the biggest ones out there. Okay? So what do you think happens, ladies and gentlemen? What happens, do you think, when one of the big hedge funds go under? You're going to see other ones go under too. Okay? I'll read this again. The Archegos event illustrates the limited visibility into hedge fund exposures. Basically, they're telling you they don't know they don't know how risky these investments are, and they don't know how over leveraged these funds are. They don't know how frightening everything could be, because they're looking at the market. The Federal Reserve truly know, or the SEC, or all of these, like the government doesn't know how much debt these hedge funds have in relation to their risky investments. So when their overvalued risky investments tank and they owe money they don't have, guess what happens? They go under, then the banks go under. Then the banks will have to be bailed out again. We might need another bailout. So we'll be bartering Lamborghinis for a loaf of bread, but it's all good. But you want to know why? Do you want to know why? Do you want to know why it's all good? The average morally superior, wonderful, God bless him and her, God bless them, the average morally superior liberal Democrat, the ICBMs could be flying above, nuclear annihilation imminent. The ICBMs could be flying above as a homeless person could be taking a poop on their car, while there could be peaceful, protests and, buildings. We don't even, it could be all happening at once, and they'll say, and the economy could collapse, and they'll say, at least it's not Trump. At least we don't have Trump's mean tweets. As the ICBMs descend, and they wipe the you-know-what from their car. Do you understand? They only care about Trump's tweets. They don't care about anything else. So when there's a market collapse, not if, because there's going to be a market collapse, unfortunately. And God forbid it happens. I hope I'm not wrong, but I'm predicting this. I hope I'm not wrong. I mean, I hope I'm wrong, but I hope I hope I'm wrong. I hope I'm wrong. If I'm wrong, I'll be very happy. People could say, "Oh, you said this would happen. You also said Clinton would." Well, I said also Clinton would lose to Trump, but so I also said the Trump-Russia thing was a hoax, which it was. So I've been swimming upstream, mostly right, sometimes wrong. But I hope I'm wrong about this. If I'm wrong about this, good. I don't want to be right about this. Who wants to be right about this? This is horrible. You have to understand the mentality, though. They don't care. They really don't care. Indy Wood. I'm changing the martial arts saying too. I've been expecting you, moi, an actor addict. Indy Wood. Indy, that's right. It's, come on now. Give me a kiss, more. Indy Wood. Indy Wood. Thank you. Thank you, Indy. Thank you, Indy. So, the Fed also acknowledged, Indy, thank you so very much. This is the important. The Fed also acknowledged that regulators lack the tool to monitor the risk trading of traders like Bill Wang, who placed large leverage bets on stocks through his Archegos family office. So, then the Fed governor added, quote, the potential for material distress at hedge funds to affect broader financial conditions underscores the importance of a more granular, higher frequency disclosures. So they want to know, they want more data from these hedge funds and banks, more progress reports on how their debt is holding up in relation to market fluctuations. Look, any correction now in the market is not going to be good because you have people who will, you have these hedge funds and banks who will have to address margin calls. It's not going to be good. She added the potential, so the warning about unseen hedge fund risks came. Unseen hedge fund risks. When the hedge funds go down, then the banks will have to bail them out, and then if the banks go down, then the government will have to bail them out. It's going to be the same thing as '08. The difference, though, is that we've sabotaged our economy through through ideas that are the brainchild of maniacs who are obsessed. They've given their life to one thing, and we know what that thing is. Satan? No. We know that all they care about is the pandemic. They have obsessed over it. They have reacted in the most irrational, illogical, paranoid. More people lose their life from heart disease and cancer. But instead of focusing on a cure for cancers, instead of focusing on, health and maybe obesity, and no, we can't do that because we'll hurt people's feelings, so we just focus on this. And it's not helping the economy any, okay? It's not helping the economy any. Indy Wood, thank you. Indy Wood. So, the Fed said that banks... Okay, the Fed said that banks remain well capitalized and leverage at broker-dealer is low, but then I just read articles saying that margin is at an all-time high. So I don't even. Oh, the banks. Okay. Well, if the banks remain well capitalized and leverage at broker dealers is low, then how did Archegos go under? Maybe they're not talking about how hedge funds are over leveraged. Existing measures of hedge fund leverage are, quote, somewhat above their historical averages. Somewhat above? Okay. It said, adding that the data, quote, may not capture important risks from hedge funds or other leveraged funds. Yeah, it doesn't, because the data is wrong, as usual. The data points and information, they're all wrong. But God forbid we might find out the hard way. I don't want this to happen, because you know what? So many good people are going to, yet again, we just went through last year with the hysteria and paranoia. What media does is profit off the emotional roller coaster, the hysteria, the mania. And it's like, I am doing this segment. I'm going to do a segment like this every day. And you know I obsess over things, but this is important. Save your money. Save. If you can save money, make sure you have it for a rainy day. You know, don't think about, like, people are talking about investing. Save as much money as possible. Save as much money. I would even say, you know what, if you, what do you want to say? Just save us, find the best ways to save as much money as possible. Okay? That's it. Whatever you can do to save as much money as possible, do so. And so compounding the frustrations, U.S. regulators, the biggest losses in Archegos affairs were suffered by banking desks directly supervised by officials in other countries. U.S. regulators signaled their concerns about hidden leverage in financial markets soon after Archegos went under. In March, the Financial Stability Oversight Council, headed by the U.S. Treasury Secretary Janet Yellen, restarted its hedge fund. Restarted. Well, I think we'll restart this. Why? Well, because one of the smaller hedge funds went under. It really was bad. Tens of billions were lost. Well, let's restart it. Why didn't you have it? Why didn't you have this Financial Stability Oversight Council always? Well, we didn't need it. But Archegos went under. Aha! You see? We didn't need it until Archegos went under. But why didn't you have it before? Maybe to warn us that Archegos would go under. That's not the way it works. Sorry. You lose. Restarted its hedge fund oversight group to assess risk taken by leveraged investment funds. Well, that's good. Not late to the game at all. Totally fine. Totally fine. Totally fine. You're the worst hedge fund leverage invest. Hold on. You're the worst Financial Stability Oversight Council hedge fund group ever. You didn't even start before Archegos went down. It's okay. They're just now starting. The government is just now looking into... Oh, that's good. The government's just now looking into... looking into if the leverage within these hedge funds is, could lead to more of them collapsing, which could then lead to more of the banks losing billions and billions. So, Fortune magazine. This is interesting. And that all of this is below in the description. Okay. No, hold on one second. Where is this? Oh, check this out. This is also interesting. So one of the top banks helped Archegos, this hedge fund that collapsed, helped them and ignored the impending disaster. By helping them. Okay, so Credit Suisse helped Archegos take potentially catastrophic risks before losing billions when it collapsed. CNN. So this is why, the regulators are powerless. That's why when you say like AOC, the billionaires, and Bernie Sanders, the billionaires, billionaire class, it's like let me tell you something. Bernie Sanders is either completely inept and a good person, or he's part of the just gigantic racket that lets all of these funds and Wall Street firms get away with everything. All you have to do is, like, Janet Yellen is just now beginning to look at the hedge fund disasters in terms of debt and leverage, because one of the smaller ones went under. Well, why weren't they always looking at this? So it's like, Credit Suisse investment bankers allowed Archegos Capital to take voracious and potentially catastrophic risks that culminated in the U.S. hedge fund's spectacular collapse in March, costing the bank $5.5 billion. So this is a small one this is a small fund that went under that cost Credit Suisse $5.5 billion. Now the larger ones could cost them, God forbid, $20 billion, $30 billion, $40 billion. They won't be able to withstand that. I could be wrong on the numbers. But if one of the smaller funds led to them losing $5.5 billion, well, I don't know, what would a larger fund look like? You tell me. I don't know. The Swiss bank published a report which uncovered persistent failures by senior managers to address risk connected with trades made by Archegos. Archegos used borrowed money to build massive positions in stocks, including media companies, Viacom and Discovery, and was unable to pay back its lenders when share prices dropped. Well, that's what happens when the margin call takes place. Its implosion cost global banks, including Morgan Stanley and Japan's Nomura, more than $10 billion and led to calls for tighter regulation. So banks already lost $10 billion last year. 3 or 4 months ago. They lost $10 billion from a hedge fund collapse. Do you want to know how many Democrats care? How about 0? They don't care at all. They don't care at all. They don't care at all. This is nowhere to be found on MSNBC and CNN, the Washington Post, the New York Times. They're going to be completely and utterly blindsided. And I hope I'm wrong, but I don't know if the collapse is going to happen next month, this year, next year. It could happen in 2022. Could happen in 2023. It'll happen during Biden's administration. He's completely clueless. The man is completely clueless. And they don't, they care only about media, but media is not looking at this. Media doesn't care about the producers and directors. This is like a Hollywood thing. When you go, I've been on CNN and MSNBC. When you go into the studios, it's like a Hollywood production. They don't care about, they don't care about truth. They care about selling. That's why they gave Andrew Cuomo an Emmy. Okay? Politics has merged with Hollywood. Media, politics, Hollywood, marketing, sales. This has nothing to do with protecting from a market collapse. They're not selling truth. They're selling whatever sells. So if it's hysteria or paranoia or tribalism pertaining to politics, they're selling that. They don't care about protecting the country. So you're continuing to do things that are counterproductive economically, that relate directly to your obsession, the hysterical, irrational, paranoid obsession with you know what, which, by the way, won't make a dent because there's a number of reasons. Ian, thank you again. Loves regulation. He's not focusing on regulating these investment banks or these Wall Street firms, or they're not focusing on their job of regulation or regulating over-leveraged financial institutions. Then they're going to complain that we didn't regulate them. They know what's happening already. There were already $10 billion in losses from one hedge fund. So they can't say, this is what they're going to say. They're going to say, oh, well, it's the Republicans' fault. The Republicans don't have the House, the Senate, and the presidency, all of Hollywood's social media algorithms. Just like they were focused on impeaching Trump and then the pandemic happened, now they're obsessed over, they're still upset. Their lives revolve around the global health crisis. But they're not actually helping people. They're helping themselves politically. That's it. And they're hurting the economy even more than they already did last year. So this is what happened. Credit Suisse punished 23 of its employees. It's like, what? Following the hedge fund collapse, canceling or clawing back bonuses $2 million. So the millionaires didn't get their $70 million, including top investment bank. Okay, so the independent review found that Archegos-related losses were the result of a fundamental failure of management and controls. Well, that's probably not entirely the case. That's a nice way of saying that, well, Credit Suisse is not run by the 23 employees that probably the higher-ups made the mistake and the 23 employees got the axe, and they're probably, have hundreds of thousands or millions of dollars themselves. I love that, though. Like in a bureaucracy, they just, the you-know-what flows downhill. So it's like, why did you do that? Like, well, you told us to. The business was focused on maximizing short-term profits. Well, that's what all of Wall Street is. And failed to rank indicating conditions posed potential catastrophic risk to Credit Suisse. Although no fraudulent or illegal activities took place, there was persistent failure to manage conspicuous risk. So, the Archegos matter directly calls into question the competence of the business risk personnel. No, it doesn't. The whole system is messed up. This is just one of the funds. This is one of the smaller funds. What do you think happens when one of the larger ones go under? What do you think happens when one of the larger funds go under? Ladies and gentlemen, what do you think happens when one of the larger funds go under? If a smaller fund totaled $10 billion in losses, ladies and gentlemen, what do you think happens when one of the larger funds go under? So, these banks lost $10 billion, okay? Including Morgan Stanley and Japan's Nomura and Credit Suisse, okay? Banks in numerous countries, not just the U.S., Japan, and Switzerland. What do you think happens when a larger fund loses? They already lost $10 billion now. But do you think that Bernie Sanders cares about this or knows about this? I mean, this directly relates to wealth inequality because when the market tanks, you have a series of events, a chain of events that lead to the working class, which is what the far left and the socialists and the communists and everyone who eventually vote Democrats, they're all liberal Democrats anyway. But these are stories and these are concerns and warnings that show how devastating a future economic collapse can be for the average American, the working class, that they focus on the working class. Wealth inequality. These are phrases that the left focuses on, yet they're completely clueless and ignorant when it comes to these types of stories. They don't care. They don't even want to hear about hedge funds going under or regulators not regulating, regulators, or banks making risky investments alongside funds that they help make these risky investments. This is all happening right before our eyes, but then, see, it's the complaints, it's the grandstanding, it's the preaching, it's the pontificating from media and primarily the left and Democrats. They're going to own this. God forbid it happens. God forbid it happens. They're going to own this. K-Boss, hello. Hello, everybody. To my viewers in Jamaica, thank you for watching. Thank you for watching. To my viewers around the world, thank you for watching. One of my favorite athletes of all time is Usain Bolt. He has to be the greatest athlete of all time, if not one of the greatest athletes of all time. You look at, and we'll just go about 10 more minutes, and we'll do another segment similar to this tonight. So, this is a weird one that hedge fund assets soared to record high amid boom in trading profits. So, hedge fund assets jumped to $4.7 trillion. Okay? $4.7 trillion. Okay? You want to know what our federal budget was in 2020? $4.79 trillion. By the way, do you think anybody on the left cares about it? They definitely don't. Why do I keep bringing up that? They're just going to complain when they preside over the catastrophe and help cause the catastrophe by tanking the economy because they're paranoid about things they shouldn't be paranoid about. But here, hedge fund investments jumped to $4.7 trillion, the size of the United States budget. Okay? Our budget is around $4.7 trillion. Okay? Okay? We have a budget of around $4.8 trillion. The GDP of our country is $22.785 trillion. Hedge fund, that's not all the other investments that these banks have. Just the hedge fund investments. And one small one went under. It was like $10 billion they lost. Just a small one. $4.07 trillion in hedge fund investments. Okay? $4.07 trillion, okay? Over the past 12 months, the industry has seen more than $500 billion in trading profits. Trading profits, this is like you need the stock market, and you need it to raise capital and liquidity, promote liquidity and all that stuff. But you're not really like trading profits doesn't mean that you have a healthy economy. You can have trading profits and people on the street. Actually, we do have a homeless crisis. So you're not really generating any long-term economic growth with trading profits. They have $500 billion in trading profits. Okay? $500 billion in trading profits. Then a rebounding economy and government stimulus have helped contribute to the strong backdrop. Government stimulus is like the last thing you should ever think. That is, the government stimulus was because you tanked your economy deliberately, okay, because you're completely apoplectic and run by media. So a rebounding economy, well, this was written in June, and the economy is taken. Inflation is at a 13-year high. The consumer price index is at a 12-year high. The producer price index is at a high. All of the economic indicators, GDP has been revised downward. We're going to you-know-where in a handbasket. And Trump warned us. Don't say that Trump didn't warn us. Don't say that Trump didn't tell you. Testa, hello. Yeah. Testa, hello. Don't say that Trump didn't tell you that Biden would be an absolute catastrophe. Okay? You have $4 trillion in these hedge funds. That's the size of our federal budget. One small one went under, $10 billion like that evaporated. And then Credit Suisse fired 23 people. It wasn't the 23 people's fault, I can tell you that right now. Okay? It wasn't the 23 people's fault. I can tell you right now it wasn't the 23 people, so whatever. It is what it is. That's what they always do. They always just, the top of the bureaucracy just blames everybody below for their problems. This is interesting. The pandemic era has been great for hedge funds. This is a CNBC article. It's all in the description. Ian Moyer, everybody here, thank you. It's all in the description. Ian, I can't thank you enough as always. Thank you. Christian, thank you. Everybody here at Ben, thank you. Jeanette, thank you. The pandemic era has been great for hedge funds, which have seen their investments soar to a record high amid hopes for the economy and huge government spending. The government spending is taking place because the states have deliberately tanked their economies because Democrats are apoplectic and lack any knowledge, completely. They lack any economic knowledge. They lack any knowledge pertaining to how to rebuild the economy. They think that building bridges and roads will rebuild the economy. The Wharton School of Business said it would actually decrease GDP. So we're going to you-know-where in a handbasket. Total investment for the industry swelled to $4.7 trillion at the end of March. Oh my God. When this thing tanks, that's why I'm telling you, save your money. Save. Every month. If you could save $50, $100, $500 every month, put it in the savings. Every month. Every week if you can. The growth has come thanks both to solid performance and heightened interest from investors who continue to plow cash into the space. Over the past 12 months, hedge funds have made more than $500 billion, $552 billion, in trading profits alone. Look, they made $552 billion in trading profits, but that doesn't really Thank you, Frank. Thank you. That doesn't really like, if you make $500 billion in trading profits, what does that mean? The people are getting a commission for trades. That's fine. You make $500 billion. The money is not like leading to any new jobs. So it actually promotes even riskier investment. You're making $500 billion in trading profits. Maybe that's going to encourage you to make riskier investments. Have you heard of Enron? By the way, I bought an Enron stock certificate 20 years ago. I used to be a financial advisor, and I remember buying. I'm like, I'm gonna buy this because this is history, and we've seen it. We've seen the same thing repeat itself. If you have $500 billion, I bought it at like 60 cents, but you still could get the certificate back then. But if you have $500 billion in trading profits, do you think, ladies and gentlemen, do you think maybe that increases riskier bets? You think you're going to be more conservative with money that you don't own because a lot of this money is on margin from these institutions? That's why Archegos had a margin call. That hedge fund went under not just because it made bad investments, because it couldn't pay back the money that it borrowed because the investments went down. Had it utilized its own money in investments, it wouldn't have owned as much stock, but it wouldn't have gone under. It went under because it was over leveraged, and then the bank said, hey, you know what, pay back, or the brokerage firm say, hey, pay back what you owe, because their investments tanked. And if a margin call is when the money that you have in a certain stock goes below a certain percentage, you have to pay back. You have to inject money, a certain percent, 30% or 25% into your position to make sure you keep all your money, to make sure you keep your investment. That's what a margin call is. So you're borrowing money, but eventually you're going to have to pay back that money if the stock tanks, or else you lose your entire investment. In that time, assets under management have swelled more than 42%. So in 12 months, you had $500 billion in trading profits, and the money in these hedge funds increased 42%. So this is like a recipe for disaster. It's like a recipe for disaster. The threats come amid skyrocketing federal spending and continued easy money policies of the Federal Reserve. Also, when interest rates are at an all-time low, so when the market collapses, then what happens? Then how do you respond if you're the Federal Reserve? How do you respond? Interest rates are already low. All interest rates are already low, and the long-term debt that the government can issue isn't really giving a high interest rate. So how do you respond? And you have an economy that's not functioning. We have job openings, but we have a labor shortage. Then we have a shortage in terms of supplies. We have a supply chain shortage. I mean, the whole thing's God forbid, I hope I'm wrong. I hope this is like, I hope this is not like when I said Clinton would lose to Trump, and I hope this is like when I said Clinton would replace Biden. Okay, I hope I'm wrong. But this is like, we're going to you-know-where in a handbasket. Ladies and gentlemen, thank you so very much. I can't thank you enough. I mean, what do you think's going to happen? What do you think's going to happen if one of the larger funds go under? Did I just get a super chat? I want to thank the person, but I don't see it. You have a situation where this is like the perfect, it's like every possible thing that could go wrong is going wrong. Every possible thing that could go wrong is going wrong. And like every possible thing that could go wrong is going. David, hello. Every possible thing that could go wrong is going wrong. Really quickly before we go, let's just look. Regulators around the world monitor collapse of U.S. hedge fund. Okay, so this is interesting. The Guardian. It's all in the description. The sudden liquidation of Wang's Archegos Capital Management sparked a fire sale of more than $20 billion in assets that left some of the world's biggest investment banks nursing billions of dollars in losses. The U.S. Securities and Exchange Commission said it had been, quote, monitoring the situation and communicating with market participants since last week. The investment banks Nomura and Credit Suisse told investors they are facing huge losses from exposure to Archegos. Shares in Japan's Nomura dropped 16% and Credit Suisse dropped 14%. As analysts speculated on how much money they could lose. So eventually it was like $10 billion all these banks lost, which they could, not going to really, that's not a problem for them, but if it gets to 20, 30, 40, 50, 60 billion, 100 billion, then it's a huge problem. The interesting thing about this article is the following. The sudden collapse of Archegos was said to have begun by a sharp drop in the share price of U.S. media giant Viacom. So all that has to happen is one of their positions to drop substantially within a day or a couple of days. Then they have to pay back the margin call. And if they don't have the money to pay, if they don't have the capital or the money to pay back the debt that they owe, the company goes under. But that could happen really quickly. The fund had a big exposure to Viacom via loans, and it was forced to unwind its position, which caused the price to drop further. So what happens is you have a hedge fund that invests in Viacom. It invests in Viacom by using debt, because it doesn't just have enough money in its reserves, enough cash to buy the stock. So they buy the stock using money obtained by loans and debt and margin. then the stock goes down very quickly. Then they have what's called a margin call, and they have to pay back the loan, or a certain percentage of the loan within, like, immediately. Or they lose the investment, or a portion of the investment, and it just keeps going down. Then they lose more of their investment, then they lose their position entirely. And it was forced to unwind its position, which caused the price to drop further. As Archegos had to keep selling off its position in Viacom stock kept tanking, which caused even more people to lose money. Archegos was also forced to sell stakes in other media companies and a host of other tech companies. Banks such as Nomura and Credit Suisse offer brokerage services to clients. That shouldn't happen. That's when Bill Clinton presided over Glass-Steagall. The repeal of Glass-Steagall, that shouldn't have happened. The banks, we learned in 1929, should not be offering brokerage services. But anyway, lending them money to buy shares and other investments while also processing their trades. What a racket. It's such a racket. Oh my God, it's such a racket. So they make money initially off the hedge funds buying and selling and the trades. And they loan them money too. It's really like this complete racket. Then when it goes under, the racket ends. So Credit Suisse offered brokerage services to Archegos, which meant that, like, Credit Suisse is a bank. You shouldn't be offering brokerage services. But of course, past 20 years, they can do that. 20 plus years. They allow Archegos to buy and sell stocks using the bank's brokerage service, lending them money using the bank so they can buy shares on margin, and then processing their trades. And when the whole thing tanks, Archegos goes under, and then Credit Suisse and others write a $10 billion check. Problem is, that was for a small hedge fund. What do you think's going to happen with a big hedge fund? Robert Keller, thank you. What do you think's going to happen with a big hedge fund? That's a small hedge fund. In the chat, what do you think's going to happen if it's $10 billion in losses for a relatively small hedge fund? They even called it like a family firm. Like it wasn't. They didn't even really. There are people who don't even call Archegos a hedge fund because it's too small. But what do you think is going to happen when an actual really big hedge fund goes under? If $10 billion was the cost of, if $10 billion was the result of a small fund going bankrupt, what happens when a big fund goes bankrupt? Let's look really quickly. So, what's the size of the largest hedge fund? Largest hedge fund in U.S. Okay. So, the largest hedge funds manage $100 to $100 billion in wealth. Archegos was $20 to $30 billion. And that cost $10 billion in losses for the banks. So you could be looking initially at $50 to $60 to $100 billion in losses if one of these larger funds go under. But then what happens is you have a run on things. So people say, sell. And then the losses are exponential. We're going to we're in a handbasket. Not good. Not good, ladies and gentlemen. Not good. Very bad. Very bad. Ladies and gentlemen, God bless you. Stay safe. Save money every month. Save money every month. Focus on joy, love, happiness, laughter. If you can save $100, $500 a month, if you could save $50 a month, do so. If you could save $1,000, do so. If you could save money every single month, do so. If, God forbid, there's a market crash 5 months from now, if you could save, $2,500, $5,000, $10,000, whatever. If you could save that money, you'll be happy if, God forbid, there's a market crash. Not happy, but you'll be, it won't hurt you as much at all. Or at all. Anyway, give me your thoughts below. Hit subscribe right now. I'll be back at around, let's see, probably about 10:30. Tammy, unfortunately, many of them will. Maybe not most of them, but many of them will. Ladies and gentlemen, thank you so very much. Share this segment with anybody who thinks that, the market's going to always go up. God bless you. To my super chat, I can't thank you enough. Ian, everybody here, I can't thank you enough. I can't thank you enough, everybody. I'll be back tonight. Be here tonight at around 10 p.m. or so. 10:30. All right, everybody, thanks. I will see you tonight. Thanks, everybody.